Brexit rumours send for choppy market conditions. US election and Federal Reserve meeting. Italian budget standoff. Hi, welcome to this week's Rational Thinking. My name is George. Here are the topics for the week. Last week saw a fairly mixed week for the pound sterling as Brexit rumours caused choppy market conditions. We saw initial gains on the Tuesday through rumours over the fact that the EU were prepared to make concessions on the Irish border. This meant that if the cabinet was to agree to a deal, the EU summit could be held by the end of the month, which gave a level of certainty to the Brexit situation. However, as we went later into the week, especially by Friday, this optimism was quickly replaced by fears surrounding the Irish border. The DUP had released a statement that they were not prepared to accept the proposal in its current form, and political tensions again reared its head within the Conservative Party, as Joe Johnston, a Transport Minister for the Conservative Party, announced that he was stepping down over fears of the proposal that Theresa May had put together. In terms of data, it was a fairly important week with UK services, which is usually a strong point for the UK economy, was slowed to a 7-month low. And we had GDP figures released on Friday, which actually came in at a stronger than expected 0.6%. This was due mainly from the fact of the weather that we experienced in July in particular and the World Cup. But what is worth mentioning is that in August and September, there was no additional growth. So going into the next quarter, there isn't a lot of momentum within the UK economy. What's also an interesting talking point is that 1 month pound options implied volatility was at its highest level since February, and this points to the continued choppy market conditions in the UK economy. Last week saw the continued standoff between the European Commission and Italy over the rejection of Rome's draft 2019 budget. The EU had cut its expectations for growth within Italy, and Italy responded by labelling the analysis as outdated. This week we should see the November 13th deadline for resubmission, so expect further volatility around that date. Last week was a busy one in the US as we saw the US congressional election results and the Federal Reserve meeting. In the election results, we saw that the Democrats managed to win a majority in the House of Representatives, and the Republicans held on to the House of Senate. The election result was as expected, but we did see a downside on the dollar as we now expect to see less fiscal stimulus due to the Democrat representation in the House of Representatives. Also, aside to that, with more Democrat representation, we would expect to see less trade tensions with China, which means there was more of a risk-on attitude with investors. Towards the end of the week, we had the Federal Reserve meeting on Thursday, where they reaffirmed their monetary policy stance. So we should expect to see around about 1% hike in interest rates over the next 12 to 18 months. In sterling this week, we see the data release for average earnings for the quarter expected to come in at 3.1%. We also expected to see the key CPI year-on-year figure, which is expected to come in at 2.5%, up from a previous 2.4%. In the US, we'll see the release of the retail sales figures, and this should come in at a strong 0.5% against the previous minus 0.1%. In the euro, we also have two key releases. We have the GDP figure coming in, expected to be unchanged at 1.7%, and we have the CPI figure unchanged at 2.2%. Thanks for tuning in. Please feel free to like, share, or comment. And as always, we look forward to seeing you next week.